Vanguard index funds are undoubtedly the most popular index funds in the world. With their huge brands and low-cost fees, it's clear to see why they're so popular. In the top 10 rankings of ETFs by the amount of assets they have under management, Vanguard holds 6 of the top 10 positions. And what's even more staggering is if you combine all of what they manage from both exchange-traded and mutual funds, Vanguard is over twice as big as its next biggest competitor, iShares, with over 6.6 trillion under their management. But the problem is, with a huge amount of money under management comes a huge amount of funds that you can buy, which for a regular person just starting off investing can be confusing to say the least. I've narrowed down the top Vanguard funds to just 2, which are the same 2 that I bought in my own portfolio with over £150,000 in. Yep, I put my money where my mouth is.
Yeah, that's what we like to hear.
So in this video, I'm going to explain why I think these 2 funds are the very best ones and why I'm holding them, and how I plan to hold them right up to my target of 1 million in my investment account. Oh, and the best part is picking these funds could save you tens of thousands of pounds. So strap in, make sure you subscribe so you get to see how I get on towards this 1 million goal. Get your notifications on because YouTube doesn't always push out these videos, and let's dive in. Okay, so if I open my main investment accounts, InvestEngine has 44 different options. Vanguard on its own platform has almost double at 86 options, and Hargreaves Lansdown has even more options at 88. Faced with so many options, how is anybody supposed to know where to start? Well, the first step is actually quite obvious. There's a glaring difference between the amount InvestEngine offer and the amount that Vanguard offer. This is because InvestEngine only has ETFs, exchange-traded funds. On the other hand, HL and Vanguard have these, plus what most would class as mutual funds. There's a few variations here, but they aren't important for the purpose of this video. The lines between mutual funds and ETFs are actually quite blurry, especially when you add the word index fund, because you can have exchange-traded index funds and mutual index funds. Confusing, right? But in short, the main difference is an ETF is supposedly more easily traded, like a stock. They can be bought and sold easily, where typically a mutual fund will be bought the next day. But this has turned into a bit of a lie. While it is true, most low-cost providers, Vanguard included, bundle everyone's ETF orders into one bulk purchase, typically the next day. In fact, if you wanted to buy or sell right there and then, Vanguard will charge you £7.50 for doing so. So in that respect, they're virtually the same. What does differ though, and why I think the vast majority of people will want to ignore mutual funds, is the fees. Now, there's 2 problems here. The first is that typically the fees on a mutual fund are higher. For example, if we look at the Vanguard FTSE Global All Cap, which is a fund which aims to track the entire stock market, and then it reinvests the dividends automatically. The ongoing charge is 0.24%. If we were to select a very similar ETF version, such as a Vanguard FTSE All World VWRP, the charge is only 0.22%. Now, you might laugh and think, really? 0.02%? But the difference in fees actually does add up over time and is quite noticeable. If you were investing £200 per month over 20 years, the difference is £255. If you were a more aggressive investor and invested £1,000 per month, it would be £1,276. It may seem like nothing over 20 years, but for the ease of picking the right option in a few minutes, it's a very nice saving. I'll touch more on saving a little later as it plays a huge part in this. Now, as good as I think that saving is, that isn't the main problem. The main problem is actually this. The majority of providers that offer mutual funds are very expensive. Hargreaves Lansdown in particular, when you look closely, have this sneaky difference. On the surface, it looks like all funds are under the 0.45% management fee, but actually exchange-traded funds aren't. They have no charge. So a mutual fund is going to charge you an additional 0.45% on top of the fund fees they already charge. So it's going to get very expensive, and on a lot of platforms that charge isn't capped, so it can get very expensive indeed. The Vanguard platform is a bit of an exception to this, in that they cover all of it under the 0.15% management charge, which is capped at £375 for the year. But if you went for an ETF, you could buy it on InvestEngine and get it for the 0% platform fees. So for me, it's a no-brainer to rule out mutual funds for the majority of people, which now narrows it down to 44. Of this 44, 17 are bonds, including one that's a gilt. I don't believe you'll want bonds in your portfolio, because to be honest, in general, they have underperformed, unless, in my opinion, you are near retirement or you have less than 5 years in your timeline. There's also 4 ESG funds. ESG stands for environmental, social and governance, which means the companies within these have been screened for this criteria. Now, in my opinion, ESG is very controversial. It depends how ethical an investor you want to be, and honestly, what you class as ethical. The fees are slightly higher again at 0.24%, but if we look inside the Vanguard ESG Global All Cap, for example, even though some of these companies have met the criteria, I think it depends how ethical you think the likes of Apple, McDonald's, AstraZeneca, and Pfizer actually are. The good thing is, it does eliminate some of the brands that are classed as unethical, but perhaps not others. Personally, I'm quite ethical in other aspects of my life, so I'm not as bothered when it comes to my investments. Perhaps if I could guarantee it, but I'm not too sure that ESG is the answer, at least for now. This takes us down to 23 funds. Now, a huge chunk of the remaining depends on your answer to this question. Do you want the dividends the companies pay to be paid out to you, or automatically reinvested? In the long run, it will make next to no difference which option you go for. This table illustrates the difference between two investors, Bob and Alice. One opts for accumulation and one for distribution, i.e. paid out. And you can see after 10 years the difference is pretty much £3. Now, I think there's actually a big problem here. Having cash available is great. When the market dips, you can buy more. But the trouble is, can you actually beat the market by trying to do this? Or more realistically, are you going to take time to actually reinvest in the self and it will sit on your account as cash, and you miss out on the best days of the stock market? If you missed the market's 10 best days over the past 30 years, your returns would have been cut in half, and missing the best 30 days would have reduced your returns by an astonishing 83%. And when I asked you guys which you prefer, a whopping 63% of you said the accumulation version, so it's safe to say that we can eliminate those. But don't worry if you do want them, my 2-fund strategy has options, and I'll show you how to include them. So if we now take our results, we know we want an ETF, so we can use Invest Engine to save on the fees. We'll filter our provider, select Vanguard, and we'll go for the accumulation version, as well as ticking no ESG. Here is what we're left with. 12 funds. Now, the first thing I want to do here is eliminate any country-specific funds. The reason is we don't want to gamble that one country is going to do particularly better than another. We'll keep the S&P 500 there for a moment, but funds like Japan and Europe can go. There are some benefits of holding the FTSE, like home currency advantage, but even then, I don't know whether there will be enough growth in the UK economy specifically to risk having it in my portfolio anymore. I want to hold the UK, just not that much of it. The FTSE 100 is affected by outside factors more than the UK directly, as its business isn't just within the UK, but even then still, I wouldn't bet the bank on it. So once we remove those, the choice is coming a bit more clear. What's next? Well, sticking on a country-specific theme, we have 2 American funds, one that tracks North America and one that tracks the S&P 500, the top 500 companies in America. If you wanted some America, the S&P 500 is a no-brainer choice, and it's cheaper at just a 0.07% management fee. The question is here though, should you have your eggs all in one basket? There's no denying that the S&P 500 has performed extremely well over the past 20 years, and it's delivered the best returns. But it's also worth noting there's been periods where the S&P 500 has gone down or hasn't performed that well. According to Vanguard's 10-year forecast, they said that their Vanguard capital markets model projects higher 10-year annualized returns for non-US developed markets, 7.2 to 9.2%, and emerging markets 7 to 9%, than for US markets, which they're predicting to be 4.7 to 6.7%. So, even Vanguard are expecting non-US equities to outperform the US. Now, I definitely think this doesn't mean you should completely abandon the US, as it's still got mega growth potential leading into the future, especially as a lot of the big tech companies are based there. But I still don't think you should put all of your money in one place. Instead, we're going to look at VWRP, the All World Fund, because you are still going to get nearly 60% of your holdings in the US, but you also get exposure to other markets, and this fund has also performed extremely well. So let's remove the 2 US funds. We can also remove this one, the All World High Dividend Yield. This one has a 0.29% charge and it's a bit of an odd fund in itself. Its aim is to generate dividends, but not to pay them out to you since it's an accumulation version. Now, this could be good in years where the market's performing poorly and companies are still paying a strong dividend, but these years are very hit or miss, and holding an index fund long term will outperform dividends. And besides, if you did want this fund, you would probably want the version that paid out the dividends to you. So this leaves us with just 3 funds. 3 funds? I thought you said 2. Well, I'm actually going to tell you not to buy VWRP. Dun dun dun. So let's pull up these two funds. So we've got two funds here. The developed world, which is countries like America, Europe, Japan, UK, and some other Asian countries. Then we've got the emerging market funds, which has countries like China, India, Indonesia, which are among the top 10. What we want to do is combine both. So let's make a new portfolio and we'll add both of these. Now let's set our weighting. Let's put 90% to the developed world and 10% to emerging markets. Invest Engine in particular has a very good portfolio balancing tool which allows you to invest money and certain percentages, which will go into each one. I'll pop a link down below as you can get a welcome bonus of up to £50 when you sign up through my link. You can do this on other platforms, but you'll just need to keep an eye on your percentages. I prefer this as it's super easy, and of course I'm avoiding the platform fees on other providers. So once I've got those, take a look at this. Here's my breakdown by country compared to VWRP side by side, and my sectors and even my companies. Notice how they're almost identical, only a few percentage points between them. So we've basically replicated VWRP. Now you're probably thinking, well, what's the point in that? Well, it's nice that you can actually see emerging markets separate to develop to see how each is performing. But the real reason, which is more important, is this. VWRP has a 0.22% management fee. Now, our emerging markets fund also has a 0.22% management fee, but our developed world fund has a 0.12% management fee. So when you actually do the maths, 90% of your portfolio you're paying 0.12% and only 10% of it is 0.22%. So your fee is roughly 0.13% compared to 0.22%. So see what we've done there? Now again, as I mentioned earlier, it seems negligible, but I'll link to this calculator down below and you can work out just how much the difference in your fees will be. For me, with my current portfolio over the next 20 years, I'm estimating a difference in fees being 37,670 as I got my current setup. But if I went for VWRP, it would cost me 63,272, which I don't know about you, but it's quite a staggering difference. I could also add on to that I'll have to pay roughly 7,500 plus, maybe even more when I go into retirement, extra for using the Vanguard platform with their management fees. There's ways around this on different platforms, but with Invest Engine being zero platform fee, it works out way cheaper. There may be some fees when Invest Engine do launch their SIP or pension account, but even so, it will be way cheaper for me. I do have a link to the pre-registration, so if you're interested to be notified when it launches, make sure you sign up for that. The other benefit for me, of course, is I can actually hold the accumulation version, whereas on Vanguard, it still frustratingly doesn't have it. I have no idea why this is because it seems so basic. Come on, Vanguard. But before I show you my holdings, let me also just mention, if you are set on holding the distribution versions for the dividends, they are here. You just need to use the tickers VEVE and VFEM. You'll also see these in my Vanguard portfolio, as of course other versions don't exist on there. Likewise, if you aren't from the UK, you will need to use the tickers from your own country. There's different versions of these for different stock markets. Here are my current holdings for these funds, so you can see I actually do own them. I am slightly down at the moment, but it's nothing I'm particularly worried about as I still have 21 years on my timeline. The reason they're down is because I have only recently just transferred over. If you have any questions about these funds, let me know in the comments down below, and I hope this will save you some money on the fees. If you're wondering about other funds like the Popular Life Strategy funds, then check out this video right here where I explain why I don't hold them, or this video where I recently just took a drastic step to sell all of my stocks, and I will catch you guys over there. Thanks.